Investment advisory services offered by Pryor McCormick Investments, an Alabama-registered investment advisor. Securities offered through Stern AG Financial Services Incorporated. Member FINRA SIPC. Pryor McCormick Investments and Stern AG Financial Services Incorporated are not affiliated companies.
It's 5:35, a segment I've been promising you since we started the show. We've already gone through the healthcare stuff today in Benghazi and all these. The other third big headline today was what the Fed did, and it does affect you. It's probably the more important news story out of all this stuff today, outside of Obamacare, because it's kind of tied into this, is what the Fed did. Steve Pryor with Pryor McCormick here on his regular weekly Wednesday visit to kind of educate us a little bit. Steve, help me make sense out of this. So the Bernanke came out and surprised everybody. And based on my quick read of what happened, the markets were down 40. I think everybody anticipated he was going to continue with this idea of tapering off the Fed buying up the bonds and all. And he went the other way and put the brakes on that. And the stock market rallied, went up another, went from down 40 to up 60 or something in an instant. And then the dollar started tanking and gold went up and the interest rates went down. Everything reacted.
Yeah, what you had essentially is the Fed's throwing everybody a curve today. They started in May by predicting that this supporting of the price of bonds, the artificially low interest rates, they've been doing for a long time.
Yeah.
And it goes back before 2008. Really, in some ways, it was back 10, 12 years ago. They were artificially holding interest rates low. And that was part of the housing bubble, and that was the Fed's part that they want to ignore when they start putting blame for 2008 and the big recession. But they had paid the price. They had already told the markets back in May that they were going to start tapering off this buying program. They put $85 billion a month into buying stocks. Basically,
explain that for people who don't understand what that means. What are they buying?
They are buying bonds that are mostly mortgage-backed bonds. Mm-hmm. That's why it has so much to do with housing.
Okay.
When you buy your house, borrow money to buy it, that is securitized and is turned into bonds. And those mortgage securities back bonds. That's the asset behind it, and that's part of the problem back in 2008. But fast forward to today, and what's happening is they have been buying $85 billion worth of bonds each month. And what that does is create artificial demand for the bonds. The price of the bonds goes up, and therefore the yield, the interest rate, goes down. Mm-hmm. And that's supposed to help stimulate the economy because low interest rates keeps housing starts going. It keeps apartment starts going. It supposedly makes it easier to make money. But the problem is, it's kind of hard to rope-a-dope the American economy because everybody knows it's temporary. We had a very nice improvement in say, apartment building starts back in July. It was up 30%, but then just this past month in August, it was down 11%. Everybody's worried about interest rates going up.
And we've watched them go up. You were explaining to me they're up almost 1% here over the last few months.
Since May, the mortgage rate is up about 1%. Across the country. You can get different deals, and you have an excellent advertiser that supports this show that's great. I would check with them, and they're absolutely right. Today was basically good news over the next month or two, but it could be bad news coming because, like I said, they had already paid the price. They hinted at it. They told everybody they were going to start probably in September. They did this back in May. The market went down. Treasury bonds lost 5.5% in value in 6 weeks. There was chaos because the normal safe type investments like Treasury bonds went down the most because they're affected most by interest rates. It's the only thing really that affects their price. And so we had sort of been through the bad medicine. We'd already seen that, and investors all over the world were building into their models, building into their expectations that starting today, starting in September, they would start tapering off buying these, and so interest rates would start up. Well, they came out, threw everybody a curve, surprised everybody today, and they're not going to start that anytime soon. Now, they say they're not tied to any certain rate. A lot of people assume that, well, if the unemployment rate gets down to 7%, then that's when they start slacking off on the gasoline here. But the problem with that is everybody knows that the only real reason the unemployment rate has gone down the last year or two is that all the people being removed from the rolls, all the people who are discouraged, and they drop off the statistics.
That rate's really not legitimate.
It's really not. It's something, and you hear everything from 12 to 14% now. That's the underemployed, and it's really the people who were looking for a job and no longer looking now because they've been unemployed for a year or two. So that's what the market really looks at, not the government statistics.
And we got all these part-timers and people that have dropped out,
Yep.
and so the rate gets kind of artificially skewed. So you can't tie the GDP, for example, to that. And they lowered the outlook for the gross domestic product today, too. They don't think we're going to be that productive.
Yes, they did. But those forward-looking statements like that really don't mean a whole lot.
Mm-hmm.
Everybody's just looking
It's
at
a forecast.
Yeah, it's a forecast by the government, and we know how often those are perfect. The stock market itself is a predictive body. They look ahead and they try to plan for what's going to happen. They had a plan in place. The Fed kind of threw them a curveball today, like I said, and now the plan's got to be different. And the market hit an all-time high today. And
so let's play fantasy football for a minute.
All right.
We know we've got this little short-term reprieve. They've already given us either a head fake or a forecast that they got to end this thing soon, and at some point they're going to start it. We've got at least a 3-month window, right? Because we got another quarterly maybe in December. And
well, remember the investors look forward, and used to be the Fed moves and everything were really highly kept secrets, and people like reading the tea leaves when they came out. They tried to figure out what they're doing and predict. But here recently, they came out even today and said, look, we're going to try to make sure that we communicate our intentions to everybody, and that's the new world. So, yeah, before they actually say it, there will be all sorts of anticipation, and the money managers who guess right will be the ones that do better over the next 6 months.
And so will there be some, and I'm getting you to guess what they're going to guess, but will some people say, all right, we're good on the markets for a couple of months now if they're going to keep doing this, the easy money's out there, there'll be some cash, so the stocks stay on an upward trend, and then maybe even people out there speculating on the mortgage market will go, okay, now I'm going to do it because it's going to drop a couple of points or a quarter point or something, and they go, all right, it's bottoming out again. I'm going to grab it now because they've already said it's going up. They've already said they have to stop this crack habit that we have.
Mm-hmm.
And so you think you'll see a flurry of activity in this final quarter?
Well, typically you do. The vast majority of money that's made in the stock market is made in the last 3 months of the year.
Of the calendar year.
Of the calendar year.
Yeah.
Because if you look at it, those 3 months have made more money since, say, 1990 than all of the other months put together. You got 9 months, and combined, they make less money in the stock market over time than the last 3 months. So it should be good. We're looking forward to it.
A good close to the year. We got retail activity, holiday activity, and people seeing, maybe other opportunities to do this stuff.
Mm-hmm.
Housing prices are starting to ease up a little bit. To go up a little bit, and that's actually good for sellers.
It is. It's good for sellers, but it's also, it's bad for buyers. You got the other side. It's the problem, and I'm no real estate guy, but you know better than I. We've had a change since 2008 or so, 2007 really. We've had a change in the psychology. Everybody thinks it's a buyer's market. Mm-hmm. So even though you've got your house up for sale and you've got it at a fair price, the people, most of them, when they come in there, they're looking to lowball you.
Sure, they're bottom feeding a little bit.
Yeah, because they think there's a whole bunch of other houses down the street, and in some places that is true.
Well, one thing in my amateur observation of it is everything affects everything. We've got a lot of Obamacare discussion today. The Republicans are going to take a shot at that. That's holding back the jobs, which is connected to the GDP report, and it just all moves on and on. So let's talk about people's individual money, and this is what you do with their planning. How are folks positioned right now to take advantage of this, or to call y'all and work on this kind of scenario?
Well, there are 2 ways to really approach investing, especially in the stock market, but bonds too, and that's strategic and tactical. We've mentioned it before. Strategic is the old way of doing things where you just kind of say, I want X amount in stocks, X amount of bonds. I'll control my risk that way by how much I have in stocks, and then we'll just ride it out. As things go up and down, we'll ride it out. Don't worry, we're reinvesting at lower prices. It's going to come back faster and all that jazz. That works until it doesn't work. Mm-hmm. It worked through the 80s. It worked through the 90s because everything went up. A blind monkey throwing darts made money in the 90s. You know, when I got in the investment business in 1979, the Dow Jones Industrial Average was 800, not 8,000. So for 20 years, there were an awful lot of people that made an awful lot of money thinking they were smart, when really they were just sitting in a boat and the tide was coming in. Everything was going up. In the 10 years from 2000 to 2010, the stock market lost half of its value 2 separate times. So it becomes obvious that you can't just or shouldn't just ride it out. You know, at best, then you're like sitting in an inner tube at the beach. It just goes up one wave, down the next, up one wave, down the next.
So you got to be strategic.
Well, that is strategic. Tactical is where you go in and out. Tactical is where you have money managers. If they think the bottom's about to fall out, they'll do something about it. They'll try to get out of the market. It's a very different way of approaching things. And we don't do that with all of our money, but we've been doing that with a lot of money, especially since 2008. We have one manager that, as a matter of fact, we don't even use him anymore, but it's one of the first ones to make a big call in 2008. He took all of our clients to cash that we had with him on the Monday morning, October 10th, 2008. And he didn't do it. He got lucky he didn't do it because he knew the crash was coming, but he just couldn't find anything he wanted to buy. So rather than sit in something he didn't want to own, he put in cash. And that week started the worst week in the history of the stock market. And the rest of that year, the stock market lost 25%. And those clients who had money with him didn't lose a penny. And
that was 5 years ago, basically, this week.
Yeah, absolutely.
When Lehman Brothers went down and all that started
happening. I'm glad you mentioned that, because people go out there and they recommend money managers, they recommend advisors or mutual funds. I just want to point out, right now, when people are touting their own performance, they're saying, we did this, we did that. Be careful, because right now, everybody and his brother wants to show you their 5-year return. Their 5-year return. You go back 5 years.
Go back to the bottom, and it's easy to show growth, right?
If you don't have a good track record in the last 5 years, then you're definitely in the wrong business.
So you would suggest what? You go back 10 years, look at how they did before and after and during?
Always go back in 10 years. But the main thing is look what they're doing now. Look what they are buying, how they're buying it. Do they hold it? What are their ideas?
How do you know what you're looking at?
Well, that's where we come in as far as looking under the hood for different managers, because we want all of our managers basically to protect our clients one way or another. They want to hedge one way or another. Most of them do it in different ways. Some of them do it by getting out of the market. They just go over into cash. And if they time it right, that's a great thing. Some of them do it by taking a small portion of the investable assets and betting against the market, so that when they lose on one side, they make a big gain on the other side. There are many ways to hedge, and we want our managers to hedge, but we don't want them all doing the same thing.
Now, I remind folks, we're almost, the time is so fast with you, Steve, we're almost halfway through the segment. If you do want to call, have any generic questions about any of this stuff, the numbers are the same, 9411011. Steve's happy to take your questions about your own situation or whatnot. Also, toll-free 866-551-9933. So what I'm hearing, Steve, from you is this. In the last 5 years, there are 2 rules of thumb that are out the window. And see if I'm right about this. 2 things when it comes to all your money. One, houses never lose value. I grew up. They'd always say real estate.
I used to hear that too.
Real estate never goes down.
Yeah,
and
always goes up.
If you're in the long haul, real estate, and it did. And then the other one was stay the course when you get in stocks. Just stay the course. Like you said, ride it out. Those were 2 things that the old wise owls would tell you as I was in my formative years, finally making enough money to put it somewhere. Have those things radically changed in the last 5 years?
Well, it's actually, as far as stocks are concerned, back to the year 2000. 2000, 2001, 2002 were the 3 worst consecutive years the stock market has had in its history. And that lost half its value, and it was just painful. Believe me, 3 straight years of down years. It was tough. And then we had a little recovery. Then 2008, the stock market went down more in 1 year than it had in 77 years. So it obviously hasn't, just to sit there and hold it hasn't worked since 2000. And it probably never worked, really. It was called modern portfolio theory. That was the theory. But the problem that we've learned is a famous quote by an investment manager that says the only thing that goes up in bad times is correlation. Now, that's not a real knee slapper for the average guy. But, people say bonds are safer than stocks. When stocks go down, be in bonds because they'll hang in there or maybe even go up some. Well, the truth is they are highly correlated. They go in the same direction when times are bad. In 2008, stocks went down, bonds
Everything
went down,
yeah.
balance. The only thing that went up was their correlation, their comparison, the way they move in lockstep with each other. And that was a big surprise for an awful lot of people. Yeah, I'm in bonds. I'm not going to lose. But there were certain kinds of bonds that you were in that you could have lost as much as the stock market. And not many, but there are certain kinds. And so it matters how you have your money in bonds. We just met with, as a matter of fact, he's a listener to this show. We met with him for the second time this morning. We were looking and talking about bonds, and it is semi-appropriate for this gentleman to have bonds, but he had it in mutual funds. And the problem with mutual funds is that you don't have the magic of maturity.
Explain that.
When you buy a bond, say it's a 10-year bond, you know two things. As long as the entity can pay interest, you'll get that interest payment every year. And then you know at the end of that 10 years, you're going to get your money back. That's the beauty of a bond. That's why you don't buy 30-year bonds right now. One thing, they don't earn much interest. And then another thing, if things go against you, if interest rates go up, you got to wait 30 years
You're stuck with it, yeah.
to get all of your money back. Well, the problem with that is if you buy those in a mutual fund, which you may be 2,000 different bonds in there, they're buying and selling all the time, but you don't have that one magic date out there where you get your money back. So we counsel people right now, if you own bond mutual funds, you might better check yourself. You might better make sure that's the way you want to go. And this particular gentleman, was ill-served, I think, by his advisor because he not only bought bonds and mutual funds, but he bought in closed-end mutual funds. Now, I don't want to get down in the weeds there, but that's a particular kind of mutual fund that trades on the stock exchange and is actually more volatile, goes up and down more than the securities it holds. Plus, they just about all pay out principal. And so here he is getting income, thinking it's all income, but really he's just spending part of his own money.
It was his own investment coming back.
Absolutely. Now, I don't want to get too technical about this stuff, but if you're going to be smart about things, you can't go by these rules of thumb. You know, there's these crazy things like you take your age and you subtract it from 100, and what's left, that's what you should have in stocks. That's just nuts. That's just nuts.
Because the world changes on you, and that makes no sense at that point.
Yeah, and the very things, like, for instance, in May, the very things you thought were going to be safe went down the most.
Because of one Fed statement, one Fed policy.
Absolutely.
And then the day it did the opposite.
Yeah, we've learned several things. One, you've got to be true to yourself. You've got to pay attention to your own objectives, make sure that's what you're looking at, not the TV screen. You've got to remain liquid. You can't buy anything that you can't sell. Another thing is you have to remain flexible. You have to be able to change. You can't be tied to some guru or some philosophy that's going to be right sometimes and wrong others.
Without the ability to adapt to the climate that you find yourself in.
And more than ever, we got to pay attention to taxes. And I mean, we talked about how you hold securities last week, and we really got a lot of interest from that because it kind of stirred the pot. And we had a conversation in our own office, and we could sort of artificially, but we sort of had an argument with ourselves about one big question that we were asked. Should you own stocks? I'm talking about just an actual stock, like if somebody owns Southern Company or CVS or some other stock like that. Should you hold stocks in your taxable account, just your regular individual account, or should you try to hold them in an IRA where it's tax deferred? And you can actually make arguments for that either way. The people who say, yes, you should hold them in IRAs, then that means obviously the stocks you're anticipating, more risk, you make more money, so you get it tax deferred. And over time, you don't pay tax when you buy or sell or when it pays dividends, any of that jazz. You only pay tax on the money when you take it out, which is appealing. That can be good. The problem there is when the money does come out, is at the highest tax bracket you will pay, which is ordinary income tax.
On the back end.
On the back end.
Right.
Now, on the flip side, people who say no, you should own it in a taxable account, point out that it's already got tax advantages built in. For starters, you buy that stock, you don't pay tax on the gain on it until you sell it. So you do sort of have control there. And ultimately, when you do pay tax on it, if you've got a gain and you've held it more than a year, it's a low tax bracket. It's the lowest, it's called long-term capital gains rate, and the maximum that can be is 20%.
That was my next question. So you could wind up paying 20% rather than 28% or whatever.
Or 39%,
whatever new tax bracket, they come up
whatever
with.
tax bracket you're in. The other idea is that if the company pays qualified dividends, that instead of paying ordinary income tax rates, then again, you pay long-term capital gains rates on the dividends. So that could be very good. And I just want to make sure I get this point about, because regardless of how you feel about that, one of the most underutilized strategies, tactics in all of investing is tax loss harvesting. Now, we've mentioned this before, but I'm not sure. I just want to make sure everybody gets it.
Tax loss harvesting. Explain that.
If you own any investment out there, any investment, stocks, bonds, piece of art, whatever, and it is worth less today than what you paid for it, then you're carrying a loss on your books. Let's say you buy stock XYZ and you pay $50,000 for it back years ago. Today it's now worth, say, $30,000. Well, you've got a $20,000 loss showing there. And if you're hanging in there like a rusty fish hook, just waiting for it to come back, you get no benefit from that. What you could do, and this is very simple, is go ahead and sell it for $30,000 today, wait 30 days, buy it back. And what you have just done is taken a $20,000 tax loss that you can stack on your tax return. Now you can
when you buy it back, that's a new investment.
That's a brand new
separate deal.
As long as you avoid the wash sale rule, as long as you wait 30 days.
30 days is the window.
Now it could go up a little bit in that 30 days, so you pay a little bit more. But the beauty of that tax loss is you can keep it until you use it all. It counts dollar for dollar against any gain for that year. So if you have a $20,000 gain in something else, wow, it's gone. No tax on that. If you have no other gains, then you can use, for a married couple filing jointly, $3,000 this year against ordinary income. So that probably just saves you $1,000 right there. And then all the rest of it just stacks on next year's return.
You can carry it over for how long?
Indefinite until you use it.
So you can take that $20,000 and spread it out against your liability as long as you need it.
Now that's pretty simple. There is no reason anybody who has investments in the taxable accounts shouldn't do this. Absolutely no reason.
Is this something that you just need to gather, like we talked about last week, gather your documents, consult your CPA about it, understand your losses? Because if you're not taking that stuff to them, they're not going to know to give you the advice on this.
Yeah, CPAs are great to talk to about it, but I got to tell you, it's simpler than that. If you know whether you've got a gain or loss in something, then that's where you start. If you've got a loss in it and you still truly want to hold it, then there's no question you should do this, because if nothing else, if you get no other capital gains, then certainly you can use a $3,000 tax deduction every year against ordinary income.
How far back can you go with the investment? It's back to the original purchase? How far back in this particular type of investment?
Oh, well, you just have to look at your cost basis, whatever that is.
Whenever you got into it,
whenever you got
what you paid for it, then where you are now.
Right, exactly.
That is tax loss harvesting. I'm writing that down. I feel smarter now. It makes sense. I mean, take your losses, let it help you with your taxes. And I didn't realize the 30-day window, and then it puts you back in the same position as long as you're able to buy it back, if you want to set it up that way.
And one of these days we'll talk about doing that specifically with bonds, because over the next, my guess is 15 or 20 years, as interest rates go up, every bond's going to go down in value. And you can do what they call the bus ride to tax savings.
Okay, here we go. Bus ride to tax savings. Write that down, AJ. I'm going to ask him about it right off the top next week. Man, I just feel smarter every time you come in here, Steve. Steve Pryor, McCormick. Tell them how to reach you, Steve.
It's 1-800-800-8761. 1-800-800-8761 or PryorMcCormick.com.
Just one word, PryorMcCormick.com. You got all kinds of free stuff on, just like coming in here. It's just free advice. Get to know them. They're smart folks. They know what they're doing. 6 o'clock, back in a minute. Stay tuned.